Welcome back to Weekly. Joining me now to chat about macroeconomics and the markets is Martin Armstrong, the founder of AE Global Solutions. Martin, thanks for joining me on Weekly.
Well, thank you for inviting me, Andrew.
So Martin, tell me a little bit about Armstrong Economics.
We have actually always been more of an institutional advisor. I would say the primary area that we began with was currency. So that's why we basically have probably more institutions than anybody, and we've been all over the world. So we've got offices from China, Southeast Asia, Abu Dhabi, Europe, and America. So we've been doing this for about 40 years so far.
And what type of services can investors get from Armstrong Economics? I know you talk about Socrates a lot.
Well, what I've done is I've also have a background in programming, so I've created what is really the only true artificial intelligence computer system, and it writes completely analytical reports on over 1,000 instruments every day. So it's covering everything, and you don't have to worry about if it's opinion or something of that nature, which is why we're also in China. We cover all the Chinese stocks. The government knows that it's all written by a computer, and they don't have to worry about in paragraph 3 somebody sneaks in, by the way, overthrow your government. So it's all completely computer driven.
And what is Socrates?
Socrates is basically the computer system that's what I named it, is analyzing everything in the world it goes from a capital flow perspective. And so we can see how things are actually, trading on a global scale. I mean, the reason the dollar has gone up is because of a crisis more in Japan and Europe. So as capital flees there, it has to go someplace. So that's what it is. It's a distribution of capital.
And the economic confidence model is the key broader tool that allows you to make calls for major turning points. Tell us about the economic confidence model.
Effectively, it's the business cycle. We've all been taught that in school, that there is a business cycle. They just argued that, it couldn't be necessarily forecasted. And found out that it actually can be, and it's very, very, specific. Even Paul Volcker, in his book, when it came out, he says the business cycle is about 8 years. We've just defined it. It's 8.6 years, and it has picked just about every peak and low in the economy going back, throughout my whole lifetime.
I've read lots of analysis that effectively begins after World War II, but your analysis goes back centuries.
Yes, we've had to back test it. You have to understand, even the financial capital of the world migrates. In 1896, J.P. Morgan had to bail out the U.S. government because it was basically bankrupt. All right. By the end of World War I, the U.S. was the financial capital of the world. By the end of World War II, it had 76% of the gold reserves. So the capital moved from Britain to the United States, and it's in the process now of actually still moving from the United States. Eventually it will end up in China, and then it will move back to Europe, and that's how it's always been. It's never stagnant in one place.
And you had been calling for a major turning point in your model last weekend. Can you tell us about that?
Yes, this was the bottom of that particular wave. The next wave started January 18th, and will peak in 2024 and go off to 2028. So this is a major turning point. We believe what you're going to see coming out of this is more of the change in interest rates than anything. It should be also a commodity cycle as we go further into 2024, where we're going to see inflation start to return. And so it's a major focal point for where the global economy tends to change direction.
But the fact that the stocks ran into that major turning point that you were expecting last weekend, does that impact your outlook for the next, call it, 6 months?
Yeah, if we end up seeing this week, the week after that turning point, close lower than Friday the 17th, then yes, you'll get a short-term correction. But this is not does not appear to be a major long-term high. We would expect the Dow to go up even further, and the next level we'll test will be 40,000. And then after that, we're probably looking around 65,000, but that's out like by 2032.
Right, so the Dow's trading, call it 29,240 this morning. Are you suggesting that the market's going to go lower here over the next month, 2 months, 3 months, but you want to buy that dip?
Yes, I mean the market would have to go below 19,000 in order to actually say you've got a bear market. So that's pretty far away. We don't expect an actual change in long-term trend. What you have to understand is as governments are in trouble everywhere,
okay,
and as that happens, the capital shifts from the public sector, like government bonds and things of this nature, and it moves into the private sector, which is commodities and equities in general.
Is that one of the reasons why we're seeing many metrics imply speculation in markets? You look at the put-to-call ratio, you look at high yield spreads, you look at relative strength indicators. They're all incredibly rich at this point in time.
Yes, I mean, most people, ironically, coming out of 2009, you're only now getting some people starting to turn bullish.
Right.
They've missed the entire bull market. This has been the most hated bull market, I think, in history. I've never seen something go up for 11 years and everybody keeps saying it's going to go down.